G'day guys, it's Jake here. Nothing in this video is financial advice. Please do your own research when it comes to investing. Please be sure to check out my links below, including exchanges I use and social media content that I post. All right, let's go. All right, so the topic for this video is the labour market. It's the US. I'm just going over a few tweets, a couple by the same person and one by this guy, Jesse Felder, just discussing where we are in the terms of heading into recession, and is it very, very likely to happen this year or going into next year? And then look at the charts and just get the job openings and the unemployment rate, and then just look at the bond market as well to signal that. So, yep. So the first one by Jesse Felder. Yes, employment matters a lot to the Fed, but it also the most important driver of earnings. So believe it or not, if you click onto this, I'll show you zoomed in, going back to 1980, and the correlation between in the blue, which is the S&P 500 earnings EPS, so it's earnings per share, and that's forward looking, and the pink is the average weekly overtime hours of manufacturing, right? So it's the overtime hours in the labour market, of course, and you can see the correlation. Obviously, not perfectly correlated. Like it overshoots, as you can see there, the pink, and overshoots the downside and upside. But generally, if you follow it and it sort of tracks it, and you smooth this out, even if you do that, it'd be even closer. But this just, if you look at the average of these two, it's very close. Obviously, we had a divergence here. At the earnings shot up, and then the overtime hours dropped, and then eventually the S&P earnings followed it. It spiked again. They came in line, they came in line, they came in line down, and the recession, of course, in 2001. And obviously, you had one in 1990. And, you can see it comes down. So in these recessions, it drops. Okay, so you can see it drops here in 1990, 1981, 82, and then 1980 recession. It dropped really, really bad there. Dropped here in 2008. They both did, and they shot back up. And they're both very, very correlated there. And then they obviously zigzagged in alignment, and it shot back up right before the pandemic, and then it just started to decline, and then it just shot right down through the floor. As you can see, they both dropped, and then they both rose back up sharply. Stimulus money and, everything come pretty well recovered very, very quickly then. So it shot back up, and then now we're starting to decline again. And we're seeing a bit of an uptick, but, will this be another just a drop down, to signal that we are in a recession or heading very close to one anyway? And we see a nice downward shoot. Obviously, you've got these other previous recessions. And, so very, very interesting how the labour market is signalling to the S&P 500 earnings. It's not looking quite pretty, I don't think, and the unemployment rate keeps rising. So that'll put a lot of pressure on earnings, of course, because if more people being laid off in big companies, that will signal that they're slowing down, and they obviously the earnings get affected by that because you've got less people working, which less people attributing to the company's profit and revenue. All right, so that's that chart there. Next one, global market investor. This is truly remarkable. US household allocation to stocks hit 57% of total, near the highest level ever recorded. The percentage is more double than 15 years. Okay, this is now in line with 2000 dot-com bubble, the peak. US households are all in stocks. So it's showing that 57% of people are pretty well allocated to the stock market, which is the highest since the dot-com. Okay. Bubble, which is quite concerning. And they had the Great Society, whatever that was, in the 60s. So the allocation is very, very unsustainably high, and I could see it definitely correcting. And this is another indication that things are overheated and there's too many people invested. And usually when that happens, there's no one left to invest. Of course, it's got nowhere to go but down. So that's that one. Another one by Global Markets Investor. Recession alarm. The number of states with high unemployment rose to the highest level since the Great Financial Crisis, 2008. In the past, whenever unemployment spiked in such a large number of states, the nationwide jobless rate rise followed. More creative destruction coming. So that is that. And you can see in pink, I'll just click into it. You got unemployment rate, of course, and blue is number of states with month-over-month unemployment. And if you're not showing the recessions, but you can see the big spike upwards. They both shoot up. In 08, the dot-com bubble, of course, the 90 recession, and then the 80s, going in the 80s, shot up. So we're starting to see they both shoot up pretty aggressively to signal that we are heading into a recession. So that's another one. And let's quickly touch up on the unemployment rate, and I'll show you the trend ribbon. Okay. So, yeah, it's shooting definitely on the uptick and then shooting higher at 4.3%. And we've created a base and we're starting to shoot up. So that's very, very noticeable. And every time that happens, I'll show you what happens. This indicator, the recessions. Okay. So when they starts to break away and gain momentum, it just goes vertical almost about, just shoots right up. That one there did, 2020, that was a shock. And this one here, it just sharply rose up, okay? It created a base, and then boom, recession in 2008, 2000. The same thing occurred. It created a base, the ribbon turned green, and then boom, recession. It created a base, ribbon turned green, and then it took off, recession, 1990, 1982, and same sort of thing, had a little base here, and it started to shoot up, boom, recession. And then 1980, of course, created a base, green, recession. Same thing here, base, green, recession in the mid-70s. And 1969, 1970, same sort of thing occurred. We did have a bit of a fake signal here. We didn't really shoot higher, but yeah, there was a bit of fake signal there. So there's one notable one. In 1963, it started to break up, but it declined. So there was a couple of fake outs, but besides those ones, you get the green ribbon and then recession, a base, a nice base, and a nice shoot up. Recession in the late 50s, early 50s, same thing occurred, and then the late 40s, all right? So we're definitely on track to enter recession, whether this year or going into next year. It's definitely very, very close, all right? It's a matter of time. And then you got the SARM rule, which, of course, is very, very, very reliable. And every time it goes above the 0.5 level, we have 0.53, pretty well recession. So recession here, 2020, 2008, of course, 2001, 1990, 81, 82, 1980, 1974, 970. I could just go back and back, every single time. So 960, 957, 953, and the late 40s, of course. The only time it really triggered, it was a false signal, was at 1959, all right? And then went above it, and then went straight down, okay? So it was a quick fake out. And then we entered recession pretty much 5 months later, okay? So it was October 1959, and then around April, 6 months later, we had a recession, okay? So it was pretty well on track anyway, okay? So even had a fake signal. We could have a fake signal as possible, but I don't see it really trending the way it is because I'm seeing a lot of bad data and collectively and different indicators flashing, and it's just the yield curve uninverting and then inverting and then uninverting. Well, today it did occur, zero level. It just touched it and bounced off it. So I'll show you that right now. Before I do, I'll show you the job openings as well. So job openings are total non-farm payroll, and see big declines, and it turns red. That's recession, okay? We had a nice green trend, and then it was red, and boom, recession. Same thing happened in 2001. I can't go back any further, but see a decline in job openings, and that is a serious concern. You might be ending recession very soon. And let's lastly touch up on the bond market. And you got the two-year yield, okay? So you can see it's had these three peaks, 1, 2, 3, broken this upward sloping trend line, coming down to support at 3.72, okay? And this is pretty well, if you overlay, actually what I'll do is overlay federal funds rate right here, you get it's pretty correlated to, the interest rates. Exactly, the interest rates. Okay, so you see interest rates very, very closely tracking to the 2-year yield, as you can see there. And it's come down before the rates come down. And you can see it tracks at the upside, and it flattened out, of course, to downside in 2008, and down here in 2001, going into that recession. And you can see how correlated it is, okay? So this one as well, 990. And yeah, that is that. So we're starting to see it decline before the rate cuts. And that usually, it precedes it. It says here it did. In 2020, we're cutting more, the yields were dropping, okay? And then they cut rates shortly after that. Up here, 2007 or so, we sort of found a top, traded sideways and started to come down. The cuts sort of shortly followed. So they were in line there. In 2001, that was obviously yields are just plummeting, and then they had to cut. So it did precede that one. And this recession here, we really had a decline, but the cuts started back here in the late 80s. And they're pretty well in line. So that wasn't a leading indicator in that one. Or 2008, okay, they were in line, but with 2001, it dropped before the cuts, and also in 2020 or 2019, I should say, 2019, and going into 2020, obviously when that crash, recession, and now we are leading. The yields are leading the cuts. Okay, so they're very, very certain at this point. Just when I believe September is going to be the cut. Either 25 or 50, we don't know, but that depends on the bond market and how much it drops. It will give the Fed, give them action to cut more aggressively or less aggressively, depending on how far this drops, okay? So right now we're heading towards support at 3.86%, and then the 10-year yield is at 3.825, so at support on the 10-year. And get rid of interest rates. It's about to drop even further, okay, when the rates get slammed down, so do the 10-year yields. But notably, the 10-year is still below the 2-year yield, all right? And that is, this is a lagging chart, but today we did hit zero, okay? Now it's going to come back down. When it updates tomorrow, it should just obviously push down, but we have touched it finally. So we're about to uninvert, and every time that happens, and it loads. So when it invert when it went below the zero line, yellow, and it uninverted, recession. Not long after that, 2020, and we happened here in 2006, 2007, boom, uninverted. Once it inverted, shot up, and it took a while, but eventually kicked in from May 2007 to January 2008, late 2007, and recession, of course. We had it happen here. We had a bit of a fake signal here. You had to invert and uninvert, and nothing occurred. We had to invert, and it was deep and long, and then uninvert, and then recession was on its way, and then boom, eventually kicks in. The recession kicks in a little bit later, so it inverts in 1989, and then fakes out, comes back down, chops, and then shoots up, and then eventually recession. And we have 1980. Before that, with 1978, it inverted, and then eventually it uninverted, and then boom, already in recession by then. Okay, so it was a bit late, this one, and this one was a little bit late too. So inverted again, and then uninverted, but already in recession by the 1981 there. So that's that, and that is the 10 versus 2 year, or 10 minus the 2 year, should say, maturity. And yeah, that's just the yields. Okay, when the 10 starts paying more than 2 year, which is normal, should be. Eventually, shortly after that, the recession happens. But you had 2 times, like in the 80s, where obviously it was late to calling that. But every other times at 1990, 2001, 2008, and even 2020, they all preceded a recession. So we'll see it shoot higher and just break back above. Things are normalised before a recession kicks in. We'll have to wait and see on that one. So that is that. So I hope you enjoyed this video, just going over a few tweets by a couple of different people. Just going over how the S&P 500 forward earnings and basically the job market. So the overtime hours, the job market, manufacturing, and how they are pretty correlated to each other. And then we talked about the households, how invested they are, 57%, which goes back to the dot-com bubble, how highly invested people are at the current time, which is really concerning because the more they drag in, the more when the bar comes down, they can sell and get plenty of liquidity and wipe these people out, fortunately, if they can hold on with the big correction and recession. And then, talked about the bond market, how that's sort of 2 years starting to decline before rate cuts. And that happens historically, not every single time, but it does happen. And the job market, basically the SARM rule indicator's triggered already. Unemployment rate is starting to take off after it's formed a base. And historically, that is a recession on its way. So there's those ones, and the job openings as well. Talked about going over that to suggest that they're declining rapidly, which is not good to see unless job openings happen, unless people can apply for jobs, and obviously because companies don't want more workers, they are doing the opposite and laying off workers. So that is the data I just talked about with yous. And I hope you enjoyed it. All right, so that is the job market and the bond market. So if you enjoyed this video, please smash the like, comment your thoughts below, subscribe to stay updated. Be sure to check out the links below. And I'll catch you in the next one. Cheers.